In the electric vehicle world, LG Energy Solution, LGES, has powered giants like Tesla, GM, and Ford, driving the EV revolution with cutting-edge battery tech. Their advanced batteries became the beating heart of the world's most popular electric cars, helping to accelerate the global shift away from fossil fuels. As demand for EVs soared, LGES was at the center of a technological and industrial transformation, setting new standards for performance and reliability. Its factories buzzed with activity, order books overflowed, and its role as a linchpin in the global supply chain seemed unshakable. Investors and industry insiders saw LGES as a model of innovation and growth, a company that could do no wrong in the race to electrify transportation. But in late 2025, the momentum stalled. The once relentless pace of expansion began to falter, and warning signs started to emerge across the industry. LGES, once a symbol of unstoppable growth, reported a sudden and significant financial setback. The company's quarterly results revealed losses that few had anticipated, shaking confidence in its future prospects. The news sent shockwaves through the auto and tech sectors, raising tough questions about the future of electric mobility. Industry leaders and analysts scrambled to understand what had gone wrong and what it might mean for the broader EV market. A quarterly loss wasn't just a blip. It signaled that the road to an all-electric future would be far rougher than expected. The challenges ahead were now impossible to ignore, from supply chain disruptions to shifting consumer demand. For a company that invested billions to meet soaring demand, this downturn forced a hard reevaluation of strategies and timelines. Executives faced difficult decisions about where to cut costs, how to adapt, and what the future might hold. LGES's struggles now reflect the complex dance of consumer behavior, government policy, and corporate ambition in the global shift to electric vehicles. The company's fate is now intertwined with the evolving landscape of the entire industry. The story of LGES is no longer just about batteries. It's about the uncertain future of the entire EV industry and the challenges that lie ahead for those leading the charge toward a cleaner, electrified world. LGES's fourth quarter 2025 results were grim, an operating loss of 122 billion won, or about $84 million, which was even worse than analysts had predicted. The news sent shockwaves through the industry, as many had expected a difficult quarter, but not one quite this severe. The company's financial health, once considered robust, was now under serious scrutiny. Stripping out U.S. tax credits, the real loss soared to 455 billion won. This staggering figure exposed deep struggles in LGES's core business, revealing that government incentives had been masking the true extent of the company's challenges. The underlying issues were now impossible to ignore. Revenue dropped nearly 5% year-over-year, a worrying sign for a company that had been riding the EV boom. And while full-year profit more than doubled from 2024, this was largely due to one-off factors. Overall sales fell 7.6%, highlighting a broader slowdown that could not be explained away by temporary setbacks. The numbers revealed a company fighting to be more efficient in a shrinking market. Cost-cutting measures and operational changes were being implemented, but the scale of the challenge was daunting. LGES was being forced to adapt quickly or risk falling further behind. Investors reacted swiftly. LGES shares dropped nearly 1% after the announcement, reflecting shaken confidence. The market's response was immediate, as shareholders questioned the company's ability to weather the storm and return to growth. The loss wasn't just a bad quarter, it was a warning that the era of easy EV growth was over. Demand was cooling, and the industry was entering a new, more competitive phase. Companies could no longer rely on rapid expansion to cover up inefficiencies. Battery makers and automakers alike now faced a new reality: intense competition, shrinking margins, and a need to rethink the future. Strategic partnerships, innovation, and cost control would become more important than ever before. The financials confirmed what many feared. Headwinds were gathering, and the industry's next chapter would be defined by challenge, not just opportunity. The path forward would require resilience, creativity, and a willingness to make tough decisions. LGES's results became a bellwether for the entire sector, signaling that the days of effortless growth were behind, and a new era of adaptation and transformation had begun. The root of LGES's troubles? Slumping demand for electric vehicles. Early adopters had already bought in, but mainstream consumers hesitated. High prices, interest rates, and range anxiety all played a part. Automakers faced unsold EVs piling up, forcing discounts and squeezing suppliers like LGES. The industry's problem flipped, from not enough supply to not enough buyers. LGES, having ramped up production for a boom that fizzled, was left with overcapacity and shrinking orders. The market's abrupt slowdown forced a painful reckoning for the company and its partners. The EV dream hit a speed bump, and LGES was at the center of the crash. The new challenge: survive and adapt in a market that's no longer guaranteed to grow. U.S. politics added fuel to the fire. The new administration under President Trump signaled a retreat from green energy policies. The Inflation Reduction Act's generous tax credits, once a boon for LGES, now looked uncertain. Automakers and suppliers who'd bet on stable government support suddenly faced the risk of losing crucial incentives. The threat of policy rollbacks chilled investment and made long-term planning nearly impossible. If tax credits vanished, EVs would become pricier, demand would drop, and U.S. battery production would suffer. For LGES, which had invested heavily in American factories, the political shift was a direct threat to its business model. The promise of a supportive policy environment evaporated, adding another layer of risk. The industry's momentum slowed, not just from market forces, but from the uncertainty in Washington. LGES now had to navigate not just economic, but political headwinds. The fallout was swift. Major contract cancellations hit LGES hard in December 2025. Automakers, led by Ford, scrapped deals worth a staggering $13.5 trillion. Ford alone canceled a $9.6 trillion contract for next-gen EV batteries, a devastating blow to LGES's future revenue. Even commercial vehicle suppliers like Freudenberg pulled out, signaling the slowdown wasn't limited to passenger cars. These cancellations triggered a domino effect. Factories built for these orders now faced idleness, and the company had to scramble to adjust. The loss of such massive deals was a tangible, multi-billion-dollar shock. LGES's order book shrank overnight, and the pain rippled through its entire operation. The market downturn was no longer theoretical. It was real, immediate, and costly. The company's future suddenly looked far less certain. Ford's pullback was just the start. Across the industry, automakers were slamming the brakes on EV plans. GM took a $6 billion write-down and paused battery cell production at 2 U.S. plants it runs with LGES. These plants, crucial for GM's Ultium EVs, went idle for at least 6 months, slashing LGES's output and revenue. The reason automakers feared overproducing EVs no one was ready to buy. Scaling back was painful but necessary to avoid deeper losses. For LGES, these moves by its biggest clients left it with underused factories and a gaping hole in its order pipeline. The write-downs and production halts weren't just headlines, they were direct hits to LGES's bottom line. The fortunes of battery makers and car companies were now more intertwined and more vulnerable than ever. The era of aggressive EV expansion was over. Survival now meant caution and adaptation. With losses mounting and contracts vanishing, LGES had to pivot fast. The company found itself at a crossroads, facing tough decisions that would shape its future. The pressure was on to act quickly and strategically, as every day brought new challenges and uncertainties. The company began selling U.S. factory assets to Honda, raising much-needed cash and diversifying its customer base. This move not only provided immediate financial relief, but also helped LGES build new partnerships and reduce its dependence on a single market or client. It also considered suspending operations at some plants, including a joint venture with GM, to cut costs and avoid further losses. These were difficult choices, but necessary to keep the company afloat during turbulent times. Running half-empty factories was unsustainable. Temporary shutdowns, though costly and disruptive, were necessary to prevent even greater financial strain. The company had to balance short-term pain with long-term survival. LGES shifted from rapid expansion to operational efficiency, managing inventory, optimizing schedules, and making tough calls on unprofitable assets. Every resource was scrutinized, and every process was reevaluated to maximize efficiency and minimize waste. The goal: weather the downturn and preserve financial health for the long haul. LGES aimed to emerge from the crisis not just intact, but stronger and more resilient than before. These moves showed LGES wasn't waiting for the market to recover. It was taking control, right-sizing its operations to match new demand realities and proactively shaping its own destiny. The painful adjustments were essential for survival. Employees and leaders alike had to adapt, learning to navigate uncertainty and make difficult sacrifices for the greater good. If successful, LGES could emerge leaner, stronger, and ready for the next phase of EV growth. The company's ability to transform itself now could set the stage for future innovation and leadership in the industry. The company's future now depended on its ability to adapt quickly and decisively, proving that resilience and bold action are key to surviving and thriving in a rapidly changing world. The full picture isn't out yet. LGES's final audited results, due January 29, 2026, will reveal the true extent of the damage. Investors and analysts are watching closely for details on net profit, business segments, and the impact of U.S. tax credits. The announcement will also clarify LGES's next moves, plant suspensions, asset sales, and cost-cutting strategies. This is more than an earnings report. It's a chance for LGES to reset expectations and restore confidence. The company's leadership must lay out a credible plan to navigate the crisis. What LGES says and does on this day will set the tone for its future and for the entire EV supply chain. The stakes couldn't be higher. The road ahead for LGES is tough, but not hopeless. The immediate challenge: survive the market slowdown and political uncertainty, especially in the U.S. LGES must cut costs, stay flexible, and diversify beyond any single market or policy. Yet, the long-term trend toward electrification remains intact. Better batteries and charging infrastructure will eventually drive mass EV adoption. LGES's scale and expertise position it to benefit when the market rebounds. The downturn could even open doors, acquiring weaker rivals or securing new contracts with automakers seeking stability. Success now depends on executing a smart, disciplined strategy, balancing crisis management with continued innovation. If LGES adapts, it can emerge more resilient and ready to lead the next wave of the EV revolution.